Good morning, everyone, and welcome. Today, we're diving into a comprehensive guide to mortgage loans. We'll explore the different types available, understand their benefits and potential risks, and help you make an informed decision when choosing the right home financing option. Whether you're a first time buyer or looking to refinance, this presentation will provide valuable insights to guide you through the process. Let's get started. Mortgage loans are essentially borrowed money used specifically to buy real estate, with the property itself serving as collateral for the loan. It's important to understand the different types of mortgage loans available because selecting the right one depends heavily on your personal financial situation and your goals as a homeowner. Each type of loan comes with its own set of terms, advantages, and potential risks, all of which can affect your monthly payments, how easy or difficult it is to qualify, and the total cost over time. Ultimately, the mortgage you choose plays a crucial role not only in the approval process, but also in shaping the overall financial commitment involved in buying your home. A fixed rate mortgage means your interest rate stays the same for the entire duration of the loan. This consistency allows you to have predictable and stable monthly payments, which is really helpful when planning your budget and managing your finances over the long term. This type of mortgage is particularly beneficial if you plan to live in your home for many years, as you won't have to worry about your payments increasing unexpectedly. However, one thing to keep in mind is that fixed rates often begin higher than adjustable rate mortgages, so your initial payments could be higher compared to other options. An adjustable rate mortgage, or ARM, starts with a lower initial interest rate compared to fixed rate loans. This initial rate is often quite attractive because it leads to lower monthly payments during the beginning of the loan term. However, it's important to remember that after this initial period, the interest rate can adjust periodically based on current market conditions. When that happens, your monthly payments may increase, which introduces some financial uncertainty. Because of this potential fluctuation, ARMs are generally best for borrowers who plan to sell their home or refinance before those adjustment periods kick in, minimizing the risk of higher payments down the road. FHA loans are backed by the Federal Housing Administration, which means they come with government support. This backing allows for easier qualification standards. So even if your credit score isn't perfect, you still have a chance to qualify. One of the biggest advantages of FHA loans is that they require lower down payments, making them particularly appealing for first-time home buyers or those who might struggle to save a large sum up front. However, it's important to keep in mind that FHA loans require mortgage insurance premiums for the entire loan term, which can increase your overall costs. So, while these loans offer accessibility, that cost factor should also be considered. VA loans are designed specifically for eligible veterans, active duty service members, and certain surviving spouses. One of the biggest advantages of these loans is that they require no down payment, which can make homeownership much more accessible. Another important benefit is that VA loans do not require private mortgage insurance, saving borrowers extra costs each month. However, it's important to note that eligibility is limited to those who meet specific military service criteria, which makes these loans a valuable but exclusive resource for qualified individuals. USDA loans are offered through the U.S. Department of Agriculture and are designed primarily for buyers looking to purchase homes in eligible rural and suburban areas. One of the biggest advantages of these loans is that they require no down payment, which can make homeownership much more accessible. Additionally, they come with competitive interest rates that help keep monthly payments manageable. However, it's important to remember that USDA loans have geographic eligibility limits, meaning they can only be used in certain qualified locations. On top of that, there are income eligibility requirements, so these loans are reserved for borrowers who meet specific income criteria. This combination of location and income guidelines ensures the program supports those who truly need assistance in buying a home in designated areas. An interest-only mortgage means that for a set period at the beginning of the loan, you only pay the interest, which keeps your monthly payments lower during that time. However, once this interest-only period ends, your payments will go up substantially because you'll start paying back the principal as well. This structure can be risky. If property values drop or your income decreases, you might struggle with the higher payments or end up owing more than your home is worth. While the lower initial payments can be appealing, it's important to be prepared for the potential financial pressure when the principal repayments kick in. A balloon mortgage is designed to offer lower monthly payments during a short-term loan period, making it more affordable initially. However, at the end of this term, the borrower must make a large lump sum payment, which is known as the balloon payment. To prepare for this, most borrowers plan ahead by either refinancing their loan or selling the property to cover that payment. The risk comes into play if refinancing isn't possible, which can lead to significant payment shock and financial strain for the borrower. It's important to understand these factors when considering a balloon mortgage. When we talk about jumbo loans, we're referring to loans that exceed the conforming loan limits established by regulatory agencies. Essentially, these are designed for amounts higher than what standard mortgages cover. The main purpose of jumbo loans is to help finance high-value properties that fall outside the usual range of conventional loans. Because these loans involve larger sums and more risk for lenders, they typically come with higher interest rates and require stricter qualification standards. Jumbo loans are particularly suitable for buyers who need to borrow more than what conventional mortgage limits allow, often because they're purchasing luxury homes or other expensive real estate. When it comes to choosing a mortgage, it's important to understand that different types of mortgages come with their own unique benefits and drawbacks. Each one is designed to suit different financial goals, levels of risk tolerance, and plans for property, whether you're looking for short-term flexibility or long-term stability. Making the right choice means carefully considering these factors in the context of not just your current financial situation, but also where you expect to be in the future. To navigate all these options effectively, consulting with financial professionals can be incredibly valuable. They can help you identify the mortgage that fits your needs best and guide you toward making informed, confident decisions in managing your home financing.